Moving average crossover trading is with no doubt one of the oldest and most popular trading strategies out there, and has been a staple not only for retail traders but also for professionals in this industry. Now, I've always been quite skeptical about moving average strategies myself, simply because all of them have been publicly known for a long time. As a part of my ongoing research, I came across a couple of them, and so I thought it's a great opportunity to test some of them to see if they still work today. My name is David from Critical Trading, and in this video we will be looking at one of the most popular moving average crossover trading strategies, where I will present all of its rules alongside with its backtest results and an equity curve. Then I will take another strategy that's still based on moving averages, but uses them in a slightly different way to achieve much better results than the original moving average crossover. Again, I will show you all its rules, backtest results, and share my tips on how to develop it further. Let's start by looking at probably the oldest moving average crossover setup that's widely recognized in the trading industry. This setup consists of two simple moving averages, moving average with period of 200 shown by turquoise line, and a shorter 50-day moving average shown in yellow. The buy setup is formed when the 50-day moving average crosses about the 200-day moving average, like it did here. This setup is commonly referred to as a golden cross and is perceived to be a very strong bullish indicator or signal when it takes place in one of these stock indices like this one, for example, S&P 500. The sell signal gets generated when the 50-day moving average crosses below the 200-day one. Exactly that has taken place here. It's clearly visible from this chart that if this setup manages to catch a new trend, it rides it for a long time, resulting in significant profits. But does it still work today? Let's find out. Let's run a backtest of this strategy on 14 years of data on all stocks that belong to S&P 100 index. Just to sum up, these are the rules I'm going to test. Buy when 50-day moving average crosses about 200-day moving average, sell when it crosses below. For the backtest purposes, because I'm testing this strategy on many different stocks, I will set this strategy to hold a maximum of 10 different stocks simultaneously. In case there are too many signals at the same time, resulting in some having to be passed on, these are ranked by stock's annual return, 252 days to be precise. Stocks that are showing higher annual return rank higher in the list. The logic of such ranking is simple. Higher the annual return is, higher the momentum of a stock is, which makes it a better candidate, as the momentum is likely to continue. And finally, I'm including a standard market index filter as well. New trades are open only if 4 major indices are above their 200-day moving average. These are Nasdaq 100, S&P 100, S&P 500, and Russell 2000. All of these have to be above their 200-day moving average at the same time in order for the new trades to be open. Having a filter like this helps to filter out opening new trades during times of stress when markets are below their long-term moving averages, which results in avoiding trading during major crises like 2008, for instance. And one last thing, I'm testing the long-only version of this strategy as I'm applying it on stocks. So this is everything we need to get a backtest done. Let's look at the equity curve. And the equity curve of the golden cross looks as follows. Starting from the left, we can see that this area on the equity is flat, which makes perfect sense, as this is the time of bear market during the global financial crisis when all indices were trading below their 200-day moving averages. Due to this, strategy did not open any new trades, and so its equity curve is flat. But if we fast forward a little bit and look at the most recent developments, we can see that the equity curve had its peak here, followed by a drawdown, and did not manage to recover from it for a significantly long period of time. This massive drawdown over in this area was caused by the market shock at the beginning of 2020. Overall, the equity curve itself looked quite promising probably up to this point, where it had its peak and failed to recover since. Bear in mind, we're talking about over 2 years that a strategy has been in drawdown. For that reason, I would definitely not trade the strategy myself in its current state, as I personally almost always favor smoothness of the equity over profitability. This system would therefore definitely need some more work in order for me to consider trading it. But what if instead of further developing the system by adding more complexity to it and inevitably increasing the likelihood of over-optimizing it, we approach the moving averages in a slightly different way? Let's have a look at another strategy I've got prepared. This strategy is based on moving averages too, but uses them in a slightly different way. It's called moving average channel. It uses two moving averages. One is based on bars highs rather than closing prices, this one, and the second one is based on bars lows rather than closing prices, which is this dashed line here. I've got both of these to be 10-day in length. When these averages are plotted on a chart, we can see that they form this kind of a moving average channel, which is where the name of the strategy comes from. Now, as far as the actual setups are concerned, the buy setup gets generated when there are 5 consecutive bars that fall completely above the channel. In order for this criteria to be satisfied, the bars low cannot touch the upper average. So looking at this particular setup here, we've got 5 bars that are above the channel with their lows not touching the upper average. The buy setup is valid, and so the strategy buys at open the following day, so at this particular bar. The sell setup to close long positions is the opposite. Strategy closes its long positions where there are 5 bars below the moving average channel. The rationale behind this moving average channel setup is that if the market is strong enough to stay above the moving average channel for a prolonged period of time, so 5 bars, then there's a strong momentum in the market which is likely to continue. If I zoom this chart out a little bit, we can see that this setup is at first sight quite interesting. It manages to catch considerably long movements in the market, and it also manages to keep holding its positions through some significant pullbacks like this one, for instance. This particular position was sold here, where there were 5 bars below the moving average channel. So we can see that this way of using moving averages is quite different to the standard moving average crossover or just market crossing above its moving average. So let's test this strategy out. Again, here's a breakdown of the rules I will conduct the test with. I'm using 2 moving averages that form the moving average channel, one that's based on price highs and the second that's calculated using price lows. Both have the same length, 10 days. Buy setup gets generated when there are 5 consecutive bars that fall completely above the moving average channel. This means that their lows do not touch the top of the channel. Sell setup uses the opposite logic, 5 consecutive bars below the moving average channel. The rest of the rules are exactly the same as I used before. Strategy holds a maximum of 10 positions simultaneously and ranks the stocks based on their annual rate of change in case of multiple signals. Additionally, there's a market regime filter used that's based on 4 major indices. All of these have to be above their 200-day moving average in order for the setup to be valid. These are Nasdaq 100, S&P 100, S&P 500, and Russell 2000. The rationale of this filter is to avoid entering new positions when indices trade below their long-term moving averages in order to stay away during prolonged bear markets. And here we can see the 2 equity curves compared. The yellow equity curve belongs to the classic moving average crossover system called Golden Cross, and the turquoise line belongs to the system that uses moving average channel rather than a classic moving average crossover. Now, what we can see right off the bat is that the overall profitability of the moving average channel system is better. That's certainly a good thing, but obviously can't be looked at in isolation as it doesn't mean much on its own. What I'm personally more concerned with is the profitability in the context of the risk of the system. Again, we can see the flat area on both equity curves here. This is because both systems use the same market regime filter that made them to stop taking any new trades, as all 4 indices were below their 200-day moving average. Let's zoom to the most recent development of these equities, which is where we'll be able to see the major difference in between them. As I pointed out previously, this area on the moving average crossover equity is very concerning. This drawdown took place at the beginning of 2020 and is a result of a major fundamentals that shocked the markets worldwide. The reality of trading is that drawdowns like these cannot be really avoided. However, they can certainly be made smaller and managed better. That's exactly the case of the second equity belonging to the moving average channel system. We can see that it too had a drawdown here, but it was much smaller compared to the other system. Overall, the moving average channel's equity seems smoother and the system is able to recover from its drawdowns much quicker. We can see that the moving average channel has successfully recovered from its drawdown and made new equity highs here, whereas the traditional moving average crossover system has remained in the drawdown. As far as the drawdown figures are concerned, the maximum drawdown of the moving average channel system is considerably smaller than the one of the moving average crossover. The maximum drawdown of the moving average channel is about 16% compared to around 35% of the crossover system, which is a massive difference. Lastly, let's have a brief overview of the backtest results. The results on the left belong to the standard moving average crossover system, and the results on the right are of the moving average channel system. The average annual return of the moving average channel system is better, most likely driven by the fact that it's got a higher number of trades recorded when compared to the crossover system. Bear in mind that there was no leverage used in the test. I ran these tests on a cash-only basis. The percentage of profitable trades is around 50% for both systems, which is expected when it comes to trend-following systems like these. What's more interesting is the fact that the average profit of the crossover system is much bigger, but so is the average loss, which definitely needs to be taken into the account when deciding which system to develop further. For me personally, I'm always more concerned with the risk rather than profit, and the maximum drawdown figure of the moving average channel system is much better than the crossover system. So for me, the moving average channel system is a clear winner. Now, should you wish to take this moving average channel strategy away, here are a couple of tips on how to develop it further. First area would be the risk management. I actually haven't used any sort of stop loss during these tests, as stop losses generally just worsen the performance. For that reason, I would implement some more advanced risk management measures, such as advanced position sizing based on stock's volatility. I can potentially see this kind of a strategy applied onto intraday timeframes as well, although I would definitely go for timeframes starting at 10 or 15 minute, not lower. I can see this strategy applied on futures as well. I ran both tests in this video on a long-only basis, as I ran them on stock markets, which are generally biased to the upside. In general, it's much easier to trade both directions in various futures markets, and so potential long-short application of this strategy in futures could be interesting. And lastly, the exit element of this strategy can definitely be improved. I would certainly recommend to look into scaling out the positions with a view of smoothing the equity curve. And that's it for today's video. As always, hope you enjoyed it. This is David at Critical Trading, signing out.